Hello and very good morning to all our dear students. I hope you are doing fine and doing great. We are on our fourth session on the forex chapter, and we'll not start it directly. We'll just give you our 5 to 10 minutes of a recap as to what we have done and what we will be going forward completing the concepts. Okay. If you have any doubts, please do not hesitate to ask your queries, and we will able to answer it on the chat box. Okay. And first of all, very good morning, Teju. I mean, it's always good to see students like you who so sincere that I could see your, good morning at 6:30. So thank you for coming so early than the scheduled time. Okay, guys. So basically, what we have done till date, let me just explain you. Okay, just one. Yeah. Okay. So we have students completed the concept of exchange rate quotation. As I told you that I am following the study material, the ICA study material, which is available on the website also, just in case you don't have a PDF copy. It has been excellently prepared, and I also tend to use that same sequence that the Board of Studies has prepared it. Okay. Just one thing, because they had started with the concept of Nostro, Vostro and Loro accounts, which I have not covered till now. I'll be covering up today, that is for sure. And after that, I have taken the complete sequence what study material has provided. So I have made no divergence with that. So firstly, I started the concept of exchange rate quotation. Okay. And there we completed the first concept of direct and indirect quote. Okay. So that's quite important, because you need to know which currency are you working with. That's important, because direct is nothing but home currency. Just one second. Home currency price per unit. Okay. Of 1 unit of foreign currency. Okay. This is direct quote. What does indirect quote means? This is home currency price per unit of 1 unit of home currency. When we see always home currency, one thing comes in our mind, only one thing, which is the INR. Okay, rupees. So beta, it's not important that in the exam you will have the home currency only and only an INR. It could be any currency, right? I mean, it could be euro, it could be dollar. So you need to be prepared for that. Okay. The examiner tests you with your knowledge. Okay. So there's nothing which he will be complicating the things. It will be simple, just you have to apply the normal logics in that. So this is the first thing that we done. Oh, great. Sairam, a very good morning. Thank you for coming so early. So this is called as the concept of exchange rate quotation. As I told you, the examiner can give you two things. One is either a code, or one is either the symbol. Okay, if you remember. What is a code? What is a symbol? Beta, if I write a code, okay, it's INR, okay, or US dollars, and so on. When I write symbol, it is like this, it is like this, or it is like this, pound. Okay, this is Great Britain pound. So you have to see in that examination how things are given to you. Okay. Second thing which I taught you was the concept of American and European quote. Okay. In the study, this is given first, then followed by direct and indirect. So not a problem. Again, we have to follow the study material. A lot of students ask me, sir, from where should we study? Give us the additional book. See, all the resources are available on this ICA.org. Okay. Hundreds and thousands of manpowers are there who are working for your development. Just in case you get a chance to visit Institute, Noida Board of Study, just in case, you would see there are thousands and brilliant minds who are trying to work on the quality of the the education that you can be given. Okay, so you follow just the study material and all these papers which are given on your website. Okay, no other books or any study material is required, honestly. Okay, so American and European quote, it's simple, nothing much, because we have not used it much. Okay. So in American quotes, rates are quoted. Okay, rates are quoted in amounts of the US dollars. Okay, in amounts of US dollars. Okay, European rates are quoted in amounts other than US dollars. Okay, other than US dollars. So it's simple. We have not used much. We have talked about the concept of Kuwaiti dinar as one of the expensive currencies in the world. Okay, that's it. So after that, that was very simple. The third concept that we considered was the concept of the base currency. Base currency. Okay, what is the base currency? Base currency kya hai? What is the base currency? That is how you will do the calculation. If the requirement, okay, which is given, let's say it is rupees per dollar. Okay, $1 is equal to, let's say 70. Okay, $1 is equals to rupees 70, and the conversion is also for, let's say, 2351 dollars, a very odd number. So since base currency and the conversion currencies are same, so what we will do, we will multiply it. Okay, we will multiply it. Do not forget. Okay, that's the most important. And if the base currency is other than the conversion currency, then we do divide on that. So these are very basic things. Again, telling you, direct question will not be there in the exam. You will be using this concept in your main question in the exam. So first two classes were more conceptual. Last class was very, very technically prepared for your this thing. And I think golden words by Ashish sir in the last, that whatever I taught in the last class, which is the IRP and PPP, you will not only be using in this chapter, you'll be using in the coming chapters as well. Okay, international financial management, you will be using the concept of nominal interest rate, real interest rate. You'll be using the concept of IRP majorly, and some amount of PPP as well. May not be international fish rate, but yes, to some extent you will be using both of them. Okay, then we talked about the base currency, and then followed by a very important concept of cross rates. Okay, today also I will be applying this concept of the cross rates. When the direct rates are not available in the exam, you are given, let's say, INR with US dollars. Just take an example, and you're also given, let's say, USD per Singapore dollars. Okay, that is also given to you. So if you want any relationship between, say, INR oblique Singapore dollars, so you can create the relationship with the help of the cross rates. Something has to be in the division so that it gets cancelled out and you get your desired answer. Okay. In study also, you have a lot of examples on this. You should be practicing that. I'm sure you will be able to understand. Okay, guys. So now coming back to the last class, what we have done it, 3 theories. Okay. Theories of the exchange rates. Okay, very important. And since Board of Studies Deputy Director has also said, so you need to be very, very clear. Again, we are not from exam. It's just that conceptually you should be very clear. IRP. Okay, interest rate parity. Interest rate parity. What does parity means? Very simple thing. A state of balance. Okay, something which is equal, or let's say something which equates something, equates something. So IRP basically says very simple thing, that take 2 countries. Okay, let's take, one is India, one is Singapore. Okay, I'll not take that previous example of US or UK. Okay, let's take India and Singapore. What are the interest rates over there? When as a student we discuss about interest rate, there are 2 types of interest rate. One, when we have money and we go to the bank and deposit it, what is the rate of interest that we will get? You're getting the point? You have extra money, surplus money. Okay, you go to the bank and you ask that how much percentage of interest you will give me. That is called as the deposit rates. One is called as a lending rate, that you don't have a money, but you need money. Okay, you go to the bank and you said, I need a money because for all these purposes, for buying a car, buying a phone, whatever. And you take those rates. That is called as the lending rates. Okay, so examiner is not asking you to go into the detail of borrowing and deposit rates. It just talks about the normal interest rate, that if the interest rate in a country is lower than the other country, then the the exchange rate will have a greater effect. The currency for which in lower interest rate will have a stronger currency. I'll tell you what I said. Okay, maybe a little faster. So this is beta India. Just imagine. And this is Singapore. Okay. The conversion is that Singapore dollars is roughly, roughly 55 rupees. Why it is so expensive? Because the interest rates, the interest rates in Singapore is less than 1%. Okay. How much is the interest rate? That is not our course content, just an understanding. And in India, it is more than 5 to 6%, whether it is lending, okay, or whether it is deposits, whatever, you get more than. So since the interest rate is lower in this country, it has a stronger currency. The country which has a lower interest rate have a stronger currency. The country which has a lower interest rate have a stronger currency. Do not forget the country which has a lower interest rate have a stronger currency. Put this in your mind, put this in your conscious mind that yes, this is the concept. Okay, clear? And after this, we talked about the second thing, which is the purchase power parity. Okay. So purchasing power was related with beta inflation. Okay. Mehengai, DNS, whatever you want to learn. Okay. So it talks about very clear thing. It says logically. Logically means if this product is available in India and the same product is available in US, Singapore, Japan, Netherlands, Germany, whatever, the price should be same. Okay, it says price should be same. It's not saying that it has to be same, should be same. So generally, is the price same? No, sir. Why? Because of various factors. Okay, the government may have a longer, what do you call as that? Custom duty, transportation cost, XYZ, all those reasons could be there. So generally the price is not same. Otherwise, it says the concept of law of one price. Means one product in various countries should be same. Okay, should be same. But it's not generally. Okay. So that's the reason that we have to buy from the country which is little more cheaper, and we sell in those countries where the demand is higher and it can be sold at a higher price. I repeat, so we try to see where the price is lower, we buy from that country and we sell it in the market where the demand is more and we can fetch more money. Okay, clear? So this is the thing, beta. And the third was the international Fisher effect, if you remember. So not much technical over there. Fisher effect. Okay, so it talks about the relationship between interest rates and the inflation. Okay, it talks about the spot rate and inflation. IRP talks about the interest rates and spot rate. It talks about the impact of both of them. Okay, clear? After that, we made more detailing on the concept of the IRP. Okay, what we did. Now we are coming back to last session. Okay, I mean now we are starting officially from here. So then we talked about the concept of IRP, that it asks us to calculate the, I mean not ask us, it tells about the relationship that a forward rate divided by spot rate is equals to 1 plus rate of interest of which country, I'll tell you, 1 plus rate of interest. Okay, the one which is calculating, if you are calculating for dollars, here also it is dollars, so the dollar will come on the numerator, means US interest rate will come in the numerator. Okay, so this is how we are calculating. So it talks about very simple thing. It has given excellently in the study material. Just go through over there. I think I may not be able to explain in that good sense as the way it is explained in our ICS study material. Okay, so it talks about very simple thing. It says that with the help of IRP, okay, I'm telling you what it says, but the words there are more beautifully written. It talks about, it says that we can calculate the forward rate. We can calculate the forward rate with the help of IRP. Okay, and you see what is the actual forward rate. Okay, so just in case you don't know what is a forward rate, you can very well view the futures currency rate. Yes, you heard it right. We are talking about a forward rate, but as you know, there are forwards, there are futures, there are options of call and put, and there are swaps. I think sir must have told you in the last class. Okay, I'm not teaching that, don't worry. That was much better. So if you want to know that what is the future price of USD INR after 1 month, so you can view from the NSE website. Okay, just for your knowledge purpose, no trading, nothing. Sir has already told you no trading should be done unless you are a CA. So just for your knowledge purposes, that let's say today the dollar is at 76. What will be the dollar after 1 month? So you want to see the quotation, you can go to the NSE website, you can find those. So we since we have a future rate, we can also know what will be the forward rate. If today $1 is, let's say, is equals to 76, and you go to the bank, you says, I don't need currency right now, I need 1 month rate. Okay, so they would say 1 month could be, let's say, I've written $1. Sorry. Yeah, $1. Okay, $1 is equals to rupees 76. So after 1 month, okay, so $1 is say, let's say 77. You want to see that what is the rate given is correct or not. I mean, we are not here to make the arithmetic calculations. Okay, we don't need to do that. I mean to say whether that rate justifies the concept of IRP. If the forward rate as per IRP is not same as per the actual forward rate, then there is a possibility of the concept which is called as the arbitrage. Okay, the concept of arbitrage. So we sell something which is overvalued and we buy something which is undervalued. So this concept, I think you must have studied in your derivatives chapter. Just in case you don't remember it, kindly go back to the previous classes and you will get to know. Okay. So this is also quite similar to the concept of call put parity that you must have studied in your derivatives chapters. Okay. So these are quite important concepts and they are quite correlated. So make sure you're not mugging those concepts and able to understand. Okay. I'm done with what we have studied till last 3 sessions, I would say rather. Okay. So you just have any doubts, let me know. Otherwise, we can start with the next question. Okay. I'll show you the next question. Okay. Just in case in the meanwhile you don't have any, so let me show you the question. Just 1 second. Yeah, this was pending. Okay. So this is, you must have seen the assignment, beta. IC is making hard efforts to make sure that the assignment is available on the website. So there you will find assignment question number 1 because that's a new assignment. Otherwise, in continuation, this is assignment question number 13. So don't need to worry about the numbering and all that. But you can take 2 minutes to study this, okay, and then we'll start doing it. Any questions? Let me refresh the sheet. If you have any question, beta, you're not able to understand anything, let me know. Okay, so no questions as of now, I think so. Yeah. So beta, can we start with this? I'm sure you must have studied because you already had the assignment earlier. So I will not be taking much time on this. So following are the rates quoted at Bombay for pound sterling. Rupees per GBP, okay, 82.60 and 82.9. So as you know, bid rate, ask rate. Bank buys at a bid rate and sells at the ask rate. It's a 3 months forward, 2070. How to incorporate that? I think study material has explained you the concept of broken period forward rate and normal forward rate forward period determination. So you can refer from there. Otherwise, I'll explain you from here. 6 months forward, 50 to 75. And interest rates in India and London, you have 3 months, 6 months. These are the rates. Verify whether there's a scope for covered interest arbitrage by borrowing in rupee. Okay. Now the thing is that they have not stated in the last class. The question before that was, it said, if you remember, it said, is there any arbitrage opportunity by borrowing either 40 lakhs or some dollars was given? Okay, some figure in dollars. before that question, no figure was mentioned by the examiner, and they said that, can something be arbitrage opportunity is there or not? That was the thing which was given. Here in this it's a November 2017 question. Okay. So in this, again, they have not stated any amount. So you are free to take any amount. But the thing is, they are talking about the arbitrage opportunity. So the working has to be in rupees. Just in case the examiner is not asking whether there is an arbitrage opportunity or not, you can take any rate, either the rupees or pound sterling, whatever is the case, you will get full marks. Number one. Number two, do not always think that the examiner will give you that, yes, there is an arbitrage opportunity. Okay, by default, many students think that, yes, there will always be an arbitrage opportunity. It's nothing the case. It's never the case. It could be possible that no arbitrage opportunity can be found in the question. Okay, so make sure that you don't fall in the trap that you would say, yes, it is there. How to present that, I will show you. Okay, why I'm little smiling, because in the last two questions, okay, we did in the last class. Okay, you remember I was about to start with this question, then I remember, no, I should take this question in the next class. In the last two questions, we had the arbitrage opportunity. Okay, but there could be possibility that the arbitrage opportunity is not there, and when you try it, you might have a loss. Okay, so how do you do the calculation in those cases? I'll explain. Okay, so shall we start, beta? Because you have the assignment with you, right? Okay. Yeah. So how do you start this question, beta? First of all, as you can see, there are two rates which are given. One is for 3 months and one is for the 6 months. Okay. So first we'll do the calculations for 3 months, and then we'll do the calculations for the 6 months. Okay, fine. Okay. So first of all, as you know, how do we do that? We start the questions by borrowing the amount in rupees. Okay. So you can start with this. Let the amount borrowed in, rupees only. Why do I write in? Let the amount borrowed be rupees 1 lakh. Just for the sake of simplicity. Okay. So now you have 1 lakh. What does arbitrage means? You are not using your own money. Okay. So even if you have your money, you are getting a point. Even if you have cash in your books, we are always assuming that we exploit the arbitrage opportunity by borrowing the money out. We don't put our own money. Okay, it's a risk-free, investment-free profit. Okay. On a funny side, arbitrage is nothing. You are walking on the road and you found a 500 rupees. What you'll do? Very happy, have a party, something of that. So arbitrage is like that. So does every one of us find a 500 rupees on the road? When was the last time you found a 500 rupees on the road? I think a long time back. At least I found a note a very, very long time back. Okay, and that's the same. Recently, I was doing the gym, and below the machine, I found a 2 rupees coin. So I ignored it. Unfortunately, it doesn't have a value. So that was on a funny side. So arbitrage basically means, beta, that something you are not putting any money from your side. Okay, no money is yours. You're trying to borrow that. So now you're imagining that you went to the bank and you said, okay, give me 1 lakh rupees. I will pay you after say 3 months. It's a 3 months period. Okay, for 3 months. You have to do 2 workings. One is 3 months. One is 6 months. So for 3 months, you have borrowed that amount. So what you'll be doing it very first instance. Okay, you will be converting that. Okay, and the conversion. Okay, this is question number 13. Yeah. So what is the rate that you'll be taking, beta? Can you see in your assignment? Is it clear? 82.90. Okay, clear? You have the money. You want pound sterling. Okay, so you are buying and bank is selling. You are buying and bank is selling. So they sell at the ask rate. Clear? I hope now this should be clear. Okay, and how much GBP did you receive? Okay, so that comes out to be, you have GBP 1206.27. Students who are live, please do tell me if I make any mistake. Last time I made little mistake, so I'm also human. So just in case any calculation errors are there, let me know. Okay. So next step is, now you have GBP. What you can do is you can invest, okay, in GBP at the rate of 5% per annum. Okay, clear? For 3 months. Okay. Sir, here you have not done any calculation for the IRP and all that. Yeah, you can do that in the previous way. The you can calculate the forward rate and then you see you have arbitrage opportunity or not. I've started it directly. Okay, but you can very well see that whether is there any arbitrage opportunity or not. Okay, I'll show you in the previous sheet. So after 3 months, okay, beta, how much money you will get into 5%, 3 by 12. Okay, so that will be into 1206.27. Okay, so after with interest, we get how much? Receive GBP 1221.35. 348 is there, but 35 can be taken. Clear, guys? Okay. Now you will convert this GBP to INR. Okay, just to see if there's an arbitrage opportunity or not. So you will convert that into rupees. Okay, and how much money you will get? You have 3 months forward rate. Okay, so you can see the premium. Can you see the premium in your assignment? Okay, what is the premium that is there? You have to add them. 82.60. Okay, now you have to take the bid rates. Now you are selling. You are selling and bank is buying. So they will take the bid rates. Okay, plus the premium which is there as 20. So that will be 82.80. Okay, and you can convert this. $101127.645. Okay, guys, let me refresh. Any mistake have I done? Very, very nearby. Okay. Okay. So next thing, this is what we will receive after once we convert this. Okay. The amount that we borrowed in the starting, can you see this amount? Okay. Amount payable on borrowed amount that we have taken in 1 lakh. Okay. A payable rate is was not the same. Okay. Payable rate, you can see how much? 8%. Okay, it's given the starting. So how much should be paying, beta? 1 lakh into 8% into 3 by 12. So 2000, I mean 1 lakh, 2000. So if we convert that GBP, INR to GBP, we will receive 1 lakh 1000. And if we see the amount borrowed, yeah, Harshad, good morning. Just 1 second, huh? Just 1 second. Okay, 0.2 beta, 0.2, so that it becomes 82.8. Okay, so you're asking, is it 0.2 or point? So this is 0.2. This is correct. Yeah, this is correct. I'll tell you why. Just 1 second. 1 lakh 2000 minus 101127.64. So if we go for this, we will have a loss. Okay, so loss suffered is equals to 872.35. Okay, so we pay with the interest with this, and after investment we get this. So therefore, no arbitrage opportunity. I'll write it here. In 3 months. Okay, this you can show it in your 6 months time as well. That's not a problem. Again, the working will be very simple. Okay, so this is how we can do that. Harshit, is it fine, beta? I hope you have noted it down. I'll have to rub this. I'll take you back to the question. Okay, he's having a little bit of a problem in terms of that. I'll tell you where you can understand that. Okay, clear? Okay. So, beta Harshit, it's for you. I'm explaining you. Okay, let me take the red color. So, beta 82.6 by 90 and 20 and 70 are 3 months forward. Okay, so how do you interpret that? I told you in the first class itself. How do you have to do the calculation? You have to add 82.60, okay, plus 0.20. Okay, clear? Clear? Okay, so whether is there any arbitrage opportunity over there or not, we can able to see here only. Okay, how come? You have a forward rate 82.80, okay, and spot rate 82.60. Okay, all these calculations, okay, all these calculations, this is in rupees. Okay, so you get so this is equate to 1 point this 4.8 is for 3 months. Okay, so for this thing it will be 0.2 divided by how much? For London it is 5. So are they equal? Let's see. So this comes out to be 2.42%. Is it equals to with this? .40%. So since they are not equal, there cannot be an arbitrage opportunity. So even if you don't show this calculation in the exam, that's fine, because in the last question of our last class, I showed you this calculation. What this formula was: FR by SR is equals to 1 plus interest rate of the currency for which you are working, about 1 plus interest rate of the other currency. Okay, so this is how all the calculation we have done. Even if you don't show it to the examiner, that's fine. But yes, you will have to show whether there's any arbitrage opportunity or not. Now for 6 months, can you do that simply? I'm sure you will able to do that. There's no problem. I'm just giving you the answer that even in the 6 months, you will not get the arbitrage opportunity. You have to do it in the very same manner. Okay, so you can take the interest rate as 10 and 8 over here, and the premiums are given to you, so you can do the calculation. Okay. Okay, some good questions are now coming. Let me refresh it again. Okay, good morning, sir. 0.01, sir. Sairam Singh, you've taken ask rate for conversion. Okay, now she's here. Fine. Okay. If we do other way around, we can create an opportunity. But since question, yes, very good, Naveen Prakash, very good. First of all, Harshad, beta, tell me, is it okay when we will multiply with 0.001? I'll do the question, Harshad. You have written a 0.001, say multiply when we are supposed to do. I'll explain you. Okay, we have a question over there. Trust me. Okay, we'll get it. Okay. Okay. Naveen Prakash has stated a very brilliant question. I think he isn't synchronized with the examiner. He says that it could be possible that there could be an arbitrage opportunity by borrowing in the pounds. But since the examiner has asked that we have to do it in this rupees only, so we have to show it in rupees. Very good, Naveen. You are absolutely correct. Since the examiner has stated that is there any arbitrage opportunity in borrowing a rupee or not, then we're doing. In the last question that we did, the examiner gave us both the things that either we can borrow in rupee or either we can borrow in pounds. So then we use this formula and first to see that whether it is arbitrage opportunity or not. Here it is directly asking you that just tell me in rupees is there arbitrage opportunity. So I did not carry out this calculation. Very nice, Naveen. Thank you so much. Thank you, Harshit. You have to be a little patient, okay? And whether it is CA or whether it is investing, you have to be very, very patient, okay? Okay, so let's talk about the next question now. 6 months you'll be able to do, I'm sure, okay? I have full confidence. So, beta, this is the last question for the covered interest arbitrage, and then we can start with the Nostro, Vostro and Loro accounts. We'll end this topic and we'll start with the forward contracts today itself. Okay, just be more patient. Just do that. Oh, sir, show the solution. Solution तो मैंने रब कर दिया. I'm sorry. आपको थोड़ा वीडियो पीछे करना पड़ेगा. Sorry for that. Okay, Saira, don't mind. Okay, so we can wait for you for a minute till the time other students can read out this question, although it is available in your assignment, but still you can do that. Okay. Okay. So this is also your examination question, May 2016. Okay, I'm telling you all the pearls of the question you will be finding in the study material, in the previous year examination question. You don't have to go here and there to scratch your heads to do various books. That's fine. We'll do that. Welcome, Naveen. Welcome, welcome, welcome. Okay, beta, shall we start if you have read it? So given the following information, the exchange rate, okay, Canadian dollar is given as 0.666 per DM. Okay, DM is a currency, you can Google it, it's a currency. It's a spot rate, okay? And then there is a Canadian dollar for 0.671 per DM for 3 months. Okay, the interest rates are given to you 8% and Canadian dollar it is given as 10%. What operations, okay, would you carry out to earn possible arbitrage gains? Have you done this question at home? Not a problem. I'll explain you how to start with that. See, now the thing is, beta, everybody, whether you are with us on live chat or not, now is the examiner asking you that you have to check the arbitrage gain in rupees or any other currency. Yes or no? No, sir. Can we see? Yes or no? No information they're asking. Whether there is an arbitrage opportunity in DM or whether there is an arbitrage opportunity in CD. CD means Canadian dollar. So what needs to be done? Okay, let's understand that. So how do we present in the exam if nothing is given? The very important thing is the calculation of the forward rate. Okay, because that will tell you, okay, what you need to do that. Brought in more closer. It's a little far. Okay, beta. So the very important thing is to calculate the forward rate and compare with the forward rate given to you. Please write it in your notebooks just in case you have a notebook. Okay, if you're not just, if you are studying side by side, please write it. The most important thing in the arbitrage, whether it is forex, whether it is derivative, okay, you have to compare the two things. Then only you can come to a conclusion that whether there is an arbitrage or not. If you don't show it to the examiner how you arrived at a decision, you might lose marks. Okay, so the thing is you have to see. We are not from the examination, okay? But our purpose is that BUS should tell you that where students can have their marks deducted. Unfortunately, okay? So, chalo. Forward rate, how do we calculate? Simple. Spot rate into 1 plus interest rate. Now, can somebody tell me here, what should I take, CD or DM? Let's see how many people can answer. Okay, 1 plus interest rates. Okay, CD or DM. Okay, let's see. Should we try with you? Possible? So my question again, in the numerator, whether I have to take the interest rate of Canadian dollar or whether I have to take the interest rate of the DM, which is given to you. Can somebody answer? I'll give a minute, since we have to move a little more ahead as well. Okay, so one right answer has come. Okay, so let me rub this. So I'll take the correct one. So beta, since interest rate. Okay, so beta, since this is spot for Canadian dollar, okay, so Canadian dollar will come over here, okay, and not DM. Clear? If CD would come here, then DM will come here. Okay, come again. What you will be putting in spot value? You will be putting 0.666. What is this 666? It is Canadian dollar. So if you are doing for Canadian dollar, the interest rate will also be for the Canadian dollar. Very simple. Okay, clear? Shall we calculate that? Yes, sir. Okay. So 0.666 into, okay, this is for 3 months rate. Okay, so for 8 percentage and 10%, you have to change it. So this will become 2% and this will become 2.5%. Clear? Done. So 1.025, right? Yeah, and divided by 1.10. So Naveen Prakash has also given us the correct answer. Harshad, not bad. You are working really hard on your understanding. Maybe next time we can get a good answer. But Naveen, again, brilliant, very good. That is what you are expecting. I think you are trying to understand the examiner's requirement. And the more understanding you will have, the more closer will be you towards the SFM completion journey. And not only SFM. Why not? Why only SFM? The complete 2 groups. Okay. We have to move a little more further. Very nice. Your steps are going absolutely fine. Great. Okay. So what will be the answer, beta? Should I calculate that? I've converted these per annum rates to 3 months. Okay. So 0.666 into 1.025 divided by 1.02. Okay. So that will be 0.6692. Just, or 3, I would say rather. Okay. 3. Okay, ji. Is there an arbitrage opportunity? Yes, sir. How can I can say C? Do we have a highlighter? Just one second. Okay. Can you see this? No. How can you see this? I've rubbed it. This is the forward rate for 3 months. Okay. Forward rate. So, does it in line with this? No, sir. Are they same? No, sir. So that is the reason that we have to do the calculations. Okay. Now what we need to do, just look at this step very, very carefully. Okay. Do not ratify, just understand. The forward rate, listen carefully, okay? The forward rate should be, hona chahiye, should be, okay? As per IRP, it is 0.6693. Okay? The forward rate should be, hona chahiye, it should be 0.6690. But actually it is 0.6710. Okay? Look at this. color green. Okay, should be 6693 for easiness. Okay, for points domain show, and actual it is 6710. Okay, so which one is overvalued? Ratta nahi maan. No ratification beta. Okay, which one is overvalued? Sir, obviously this is mathematics. This is overvalued. Okay, for the timing, forget this point something. Okay, this is overvalued, and if something is overvalued, what we do is we sell forward. So it means if forward is overvalued, this is undervalued. Okay, so we sell forward and we buy spot. One more time. Okay, one more time. Last time I will explain one more, because this is our last question. Then we will not be covering up the covered interest arbitrage anymore. Okay, IRP, interest rate parity, talks about that what should be the forward rate. Okay, I mean, ideally, keeping in mind the interest rate, what should be the forward rate? And we try to compare that forward rate with the rate which is given to you by the examiner. Okay, so for the purpose of easiness, I have removed the decimal. Okay, so I have written should be. This should be is as per the IRP. This we have to calculate in the exam. It carries marks, beta. It carries marks. If you don't show this in the exam, this all working, all this working, this working and this working, you will lose marks, because this is the foundation of your answer for the interest arbitrage. Okay, so it is should be 6693, and actual means with the one which is given to you. So it is 6710. It is higher than what it should be, so it is overvalued. What we studied in the derivative classes, we always sell what is overvalued and we buy what is the undervalued. So we are buying spot and selling forward. Buying spot, selling forward, selling forward, buying spot. Got it? Clear? Last question. Okay, clear? So till here, no doubts? Done? So is there any arbitrage opportunity? Yes. Okay, we have already seen that there's an arbitrage opportunity and we have already done the calculation. Now how we can have to do that? Next steps, I'll have to rub this. So Sairam, beta, need your permission. Last time also you just missed, I think. So can I rub this, the entire thing, so that we can move on to the next thing over there? Okay. Okay, so what should be the next step ideally? Okay, as you know that we have to sell the forward. Okay, we have to sell the forward. So what we'll do is we will be taking a loan in Canadian dollar. Okay, just have a look. So assume amount as $1 lakh. Okay, borrow Canadian dollar 1 lakh. Assume. Why? 1 lakh is straightforward calculations, easy to do it, and no rate or anything has been given by that. At what rate you need to take. So this is quite clear. Okay, borrow CD 1 lakh, which is assumed. Okay, and once you borrow, what you'll do it, you will convert that into DM. Borrow this thing, number one. Number two, convert this CD into DM. Okay, digest that slowly. Okay, the concept is tough, I know, but it is not impossible. Okay, it is not impossible. You can do that. I still remember my childhood. People were having a lot of problems with various things. Okay, various things. I had in my childhood to make it B, something like this. B was B for ball. I am still not able to make that B. How to make that? That was very tough for me. Second was the biggest challenge was for me was to understand board mass. You remember board mass? That was again a very big challenge. And today also I don't even remember how to do the things with the help of board mass. So I know there are some concepts which are very tough in your life, but this is honestly very easily understandable and digestible. How I don't know, I have completed my CA without understanding board mass from the kindergarten classes. I don't know, but still I've gone through. So I know these concepts are tough, but not that difficult that you can't even do that. You have a caliber, you can do that. Okay, so understand that. We have borrowed CD 1 lakh and assume because amount is do that. We convert the CD into DM, and how to convert that DM? We'll do it on the spot rate itself. No bid or ask is given, so it is quite easy for us. So we'll do 1 lakh divided 0.666. Okay, so we will get DM how much? Why did I divide? Clear na? So this is the base currency which is given is the DM. Per DM rates are given, and it is 1 lakh, so we have to divide. I hope now you have become a champion on that. Okay, so we get DM 150,150. Okay, clear? So what we can do is we get the DM and we can invest this amount at this rate. Okay, clear? So 8% per annum. Okay, so how much did we get? After 3 months, we receive how 2%? Beta, because this is 8% per annum, so 2% for 3 months. I hope that's clear. So 153,153. This is what we receive. Now we have to make the repayment. Okay, so assume the amount and repayment. How much for amount? For 1 lakh into 1.025. Okay, this is 2.5%. Okay, beta. So 1 lakh into 1.025. So ये आ गया 102,500. Okay, clear? But this is in CD, this is in DM. We will just make the on a comparable basis. Okay, so we can convert this. Okay, into the CD. This is DM, right? This is DM, and we can convert this. Little difficult. Why? Because there is no home currency here. We can't find dollars. We can't find INR. You know, that is what we always like. Although it is not given, but again, it is important from examinations perspective. Okay. This was, I told you, May 2016 question. Okay. So how much did you get, beta? 153. Yeah. Now, rates are same. This is DM, this is GM. So base currency same, we will multiply that. Up to clear na? Okay. So 153 into 0.671. 102,765.66. Okay. So did we make a gain? Yes, sir. How much? Okay. So we have to pay. Okay. Outflow. Okay. Let me write this. Okay. I write here. Cash outflow 102,500. Okay. Cash inflow. How much did we receive? 102,765.66. Okay. So this is your arbitrage profit. $265.66. Okay, in CD. Okay, in CD. So clear with that? Any doubts? You have any doubts? Please ask me, because now we will be winding up this topic of covered interest arbitrage, and I'm sure you'll be satisfied with the amount of questions that we have done in covered interest arbitrage. Okay. For more, you can refer the study material, past year's question. You will have more better understanding. Okay, clear? So now we can wait for, let's say, a few minutes, and then we can do that last concept we are still remaining with, that the concept of Nostro, Vostro and Loro accounts. Again, that is pretty simple, and ICA Board of Studies has made a lot of efforts to make sure that you are able to understand that easily, but still we'll try to do that with you. Okay, we can wait for a minute or so that you are in a position to ask me any questions that you have with this perspective. Okay. Any doubts, guys? Let me know. Okay, no questions. So assumed the things are clear to you. Okay, so I'm rubbing this, and we are moving to the concept this, but first I'll explain you the concept. Okay. So Nostro accounts. Okay, so Nostro accounts is very simple. First of all, why do we need any currency? Okay, before I start with something, a very basic thing what the institute study material has started with. Okay, see what happens is, let's say you have your own bank. Okay, let's imagine yourself to be Uday Kotak, Mr. Uday Kotak. You have your own bank, Kotak Mahindra Bank. Okay, although in that they provide you other services also, and but still, okay. So you have an account here. Okay, so you have a bank of ABC. This is your own bank. Okay, and people from various countries. Okay, people from various countries. Let's say Singapore. Okay, Japan, Thailand, and so on. Lot many come and they deposit money in your account. Okay, so what are they depositing? Their own home currency. You're getting the point. You are in India. People from outside India are coming and they want to deposit the money. What is their home currency? The Singapore guy will put in Singapore dollars. Japanese guy will put in Japanese yen. Thailand guy will put in Thai baht. And others will put their own home currency. Now it becomes difficult for the simplicity that they do is, they say, okay, sir, you want to put your money over here, that's not a problem. I can convert this amount as per what is the spot rate. Okay, then your own home currency will become equivalent to India's currency. Okay, so let's say you put in 100 Singapore dollars. Okay, and 1 Singapore dollars is equals to, let's take an example, 55. Okay, so automatically you are credited with 5,500, ignoring those transaction costs or fees, all those things, for example. Okay, simple. So this is how the things are managed. Okay, for the bank it becomes little difficult to manage these things. So what happens is that a bank not only have a account in India, they also maintain accounts in their respective countries as well. Okay, in their respective countries. Okay, so when they manage the account in another currency, other countries, they are called as the Nostro account. Okay, Nostro accounts basically is very simple. means our account with you. Okay, so Kotak Mahindra Bank, okay, so Kotak Mahindra Bank creates an account in a bank called as Singapore. Okay, one account in Japan, one account in Thailand. So they are making their accounts in those countries so that the transfer of the currency becomes easier. See, imagine yourself, you are sitting in India. Some Firangi person came and he gives you Singapore dollars. Okay, some Singapore dollars. Okay, okay. Now, can you use a Singapore dollar? It worth nothing. Okay, because in India works. So how do you make sure that this goes to their own home currency? Okay, this Singapore dollar goes back to Singapore. You have converted that and you have given INR. They can spend that. Okay, somebody gave you 100 Singapore dollars. 1, 2, 3, 4, 5, 6. Okay, you kept it and you have given them INR. Okay, clear? You're getting the point. You have now the Singapore dollar. Can you use these Singapore dollars? No. India chalega. Indian currency. In India, Indian currency will work. So you have to make sure that this Singapore dollars go back to Singapore. Okay. And how can you make sure? By creating a Nostro account with banks which are outside the country. Okay. So say Singapore, Japan, Thailand, UK, US. So you create account with that. So that talks about our account. We are Indians. Our account with you is called as the Nostro account. Okay. So I hope if that is clear. Similarly, the opposite of that is called as the Vostro account. Okay. Vostro accounts. So as I told you that these are not Vostro. They are Italian words. Okay. So they are called as Nostro account. Vostro account. Okay, this is like little funnier presentation, pronunciation. Okay, so Vostro account basically means your account with us. Okay, so your account with us. Like Indians also travels a lot. Okay, they travel across a lot of countries. Okay, so the banks in various countries. Okay, say Russia, okay, Germany. So people come, these people are from India, okay, all these people. They come and put the money over here, okay. So again, if they get INR, what will they do for INR? What will they do with the INR? They have nothing to do with the Gandhiji's 2000 rupees note, Gandhiji's 500 rupees note, 1000 note is already banned. Okay, so what they will do with those notes? They will basically have to send across. Okay, so these banks create some accounts in India, so that the money that they received from Indians, okay, in their respective countries. Okay, imagine you yourself going to Germany and you need German money. So you will give the INR, they will give you German money so that you can spend on eating and shopping. So they have the INR, they want to send back that INR to India. So they create an account in India so that they can remit the INR back to India. That is called as the Vostro account. Okay, your account with us. Your account means Indians are having an account with them so that it becomes easy to maintain. Okay, clear with that? The third one, little technical but again simple, not a very big problem. Loro account. What is Loro? Because again it's an Italian word, so Loro. Loro basically means that, let's take an example that you, okay, went to bank called ICICI in Bangalore branch. Okay, just imagine it, and request them that make a payment to a country in Kenya. Okay. Will ever ICICI say ki, no, we don't have any way out that we can make the payment to Kenya? Has banker ever refused? They can't refuse. That's their job. So what they say is, okay, we'll get the payment done. Okay, so they take the amount, they take the fees and all those things. So ICICI has no correlation directly with Kenya, and they call up our largest PSU bank, okay, say SBI. They call up SBI Kolkata branch and ask them, do you have any direct connection with payment to Kenya? They would say, yes, we do have a connection. So ICICI said, some customer came to me, okay, let's name it as Rahul. So Rahul came to us and want to make a payment in Kenya. So we don't have a direct connection. We will give you the amount Rahul got paid to us. The amount paid by Rahul to us for the remittance to Kenya. We are paying it to you, please pay it to Kenya. They said, okay, fine, that's okay. So basically, ICICI is creating an account with SBI, which is called as the Loro account. Okay, so what the study material says, where the bank remits currency to another bank to make the payment in the account of a third party. What this is? A third party. Okay, so this is called as the Loro account. The account between ICICI and SBI only and only sole purpose for making a payment to the third party, since they don't have any direct connection with that country. So just to help them, later on, let's say you complete your CA and want to practice. Okay, I'm not assuming that you will be a CA. You will be a CA and assuming that you go for practice. So somebody would come say I need some help in, let's say, international taxation. So what you'll say, no, we are not specialized in international taxation. Go to some other CA. That will not be possible. You want your client to be retained. So you said, okay, we will get your work done. Then you will ask within your community, okay, that can we do this assignment together? Can we cater that client together? Okay, so you establish a relationship with other CA only and only solely purpose for that particular assignment. It might not affect your current, business. The only thing is that you have to tell them that, okay, we are working together only for this particular thing. So that is called as creating a Loro account so that you can make a remittance to the third party. Okay, guys, clear? I hope I could explain you in a simple manner. So Nostro means you are creating an account in Singapore, say Thailand, say Japan, so that you are able to put the money. When you create an account, okay, I mean, somebody was asking me, not in this class. Yes, absolutely correct, Saira. Okay, within the country to make a payment to the foreign payment, which is a third party. Okay, not related to that. Okay, so that account could be within there, or let's say SBI says I don't have a direct connection. So you will search somebody in Kenya. Okay, somebody in Kenya. Let's say there is a XYZ Bank of Kenya. Okay. You called a lot of people there. There is no one in India who have a direct connection with Kenya. So you will make a direct connection with Kenya, some of the bank. You create a bank account over there so that you can make a payment to the third party. So it could be within the country or outside country. The only thing is that you need to cater is making a payment to the third party on behalf of your client, that is Rahul. Okay, beta, clear? Now, the thing is, can you have a bank in India, can have an account in, say, Singapore, DBS Bank, okay, Singapore's largest bank? So answer is yes. What do you require? Just like the way when you go to the bank, okay, let's say you go to the bank and you want to open up a bank account. What do you want? You want an Aadhaar, you want PAN, you want a photo, okay? All those things are there. So bank doesn't have an Aadhaar, but yes, bank has a PAN. Bank doesn't have a photo, obviously. How can they have a photo? So there are certain rules that Singapore DBS bank in Singapore can create an account for any bank in ICICI. Let's take an example, ICICI Bank. They can make an account, but here if they want to put in the money, it has to be in their foreign currency. You cannot put INR in their account. You have to maintain Singapore dollar. In India, how much amount is required to be maintained? Sir, if if you remember correctly, you need to maintain 10,000 in any private bank. Okay, in SBI, I think it is 5,000. I don't know. So you maintain just like the way you maintain 10,000 in Indian bank, you will have to maintain, let's say, 100 Singapore dollars over there. And you cannot put INR there, you have to put the Singapore dollars. Okay, so that is possible. I hope that's clear, guys. So this is the concept of Nostro, Vostro and Loro accounts. How can the examiner ask you the question? I will be explaining you just after that. If you have any doubts, please ask me. So I hope, Sairam, that is clear to you, and we can move into the type of question that can be asked in the examinations. Okay. Just have a study to this. It's a bigger question, but since you already have the assignment, I'm sure you must have studied. Just in case you couldn't, spend about 2 minutes over here. Okay, so shall we start with it? You as a dealer in foreign exchange, sorry, pen. Yeah. So you as a dealer in foreign exchange have the following position in the Swiss francs as on 31st October 2004. The particular are balance in the Nostro account, and you can see an overbought position. If I talk about very simple thing, you need to prepare 2 accounts. Okay, one, I mean, for the examination purpose and real life, one is the Nostro account. It's just like a cash account. Okay, it's just like a cash or bank account that you used to prepare when you were in class 11th. You remember? Cash account debit, bank account debit. It's just like the actual transaction which is happening, which is affecting your actual balance. Okay, which is affecting your actual balance. So any debits, any credits impacts their values over there. Okay, it impacts the values over there. So Nostro account is such. When we talk about the overbought accounts, okay, so let's say there is an overbought account, but it's like a journal entry. You remember journal entry? So even if there is a transaction which has happened, which is, let's say, yet to be taken. Okay, so let's take an example that you carry out a position in forwards. Okay, forwards. Forward means that I will be delivering. Okay, just example. I will be delivering, say, 100 Swiss franc after 1 month. Okay, I will be delivering means giving someone 100 Swiss franc after 1 month. So is it affecting my cash account right now? Has any money came out of my pocket? No. Listen again. I will be paying 100 Swiss franc after 1 month. Is it impacting my Nostro account right now? No, it is not impacting. Whether it will be impacting it later on, yes. But will I remember that transaction? No, sir. There'll be a lot many transactions that will happen, right? So how to keep a journal for that? You are putting the value in the overbought account. Okay, the transaction, even if it is taking, would be taking in the future, you have to start doing a like that. Okay, clear? Okay. So you have a balance in the Nostro account, which is a credit balance, just like you have a credit balance in your bank account, which is 1 lakh. Then you have an opening position overbought, which is 50,000. Then you purchased a bill on Zurich. Zurich is in Europe. Okay, 80,000. Sold forward TT. Okay, TT is telegraphic transfer. Okay, or telephonic transfer. You can say. I mean something which is done over the phone or email itself. Okay. There was a forward purchase contract which got cancelled, and there's a remittance by the TT, actual payment, okay, which is there, and there was a draft on Zurich which got cancelled, 30,000. What steps will you take if you're required to maintain a credit balance of 30,000 Swiss franc? Currently, you have a balance of 1 lakh. You have to maintain a balance of 30,000 in the Nostro account and keep as overbought position at SF 10,000. Okay, SF 10,000. Currently, your overbought position is 50,000. Your have to keep the position at 10,000. So you can prepare it according like what study material has done. You can use a T form or you can use a vertical form. Both in both ways, the examiner will give you the full marks. He will not be deducting any of your marks. There's nothing to worry. Okay, is it clear? Done. So you want to try any questions out there? No questions? Just 1 second. So beta, can we start doing this? Is it okay? So how do we start? Let's understand. Any questions? Okay, so no questions as of now. Very less questions today. Why we? What happened? Is everything clear or is it everything all clear? This is really uh, tough situation, right? Okay, so this is clear. So now we can prepare it in the next this thing. Okay, so I hope you have the assignment with you. Okay, I'm also keeping the assignment ready with me. Okay, all these values will be required. So beta, what you need to prepare is you need to prepare the two things. One is the overbought account. Okay. It's a very, very simple concept. I mean, honestly, you will not find any technicality over here. Nostro account. Okay. So you have already a balance over here. Okay, 50,000. So you can write two. You can write either balance PD or you can write the opening balance. Both will be okay. Okay. And you have a Nostro account as well. Okay. So you can write a trade balance, buy balance CD. 1 lakh is the amount, the very first line. B. Okay, clear? Now we can start with the things which is given to you. Okay. So number one, the second point it says, after this opening balance and this thing, you can see on the left hand side, purchased a bill on Zurich 80,000. Okay. I can write it over here. Purchased a bill okay, clear? Next is sold forward TT worth 60,000. Okay, both of them clear? Now you tell me one by one. The purchased bill on Zurich. Okay, this is overbought account. This is Nostro account. If I purchased a bill, buying a bill means what? When do I buy a bill? When I buy something. When I purchase this mouse, I will get a bill. I will get an invoice. Okay. So the bill has been received. Have I made the payment of that? Have I made the payment for that? No. So if my cash account has not been impacted, okay, so what is it impacting? To purchase a bill which is worth 80,000. No impact will come here. Okay, no impact will come here because there's no outflow. Somebody has given me the bill. Unless and until I don't make a payment, nothing impacts my cash account. So similarly, if I purchased a bill or sold a bill, it is just like I'm putting the value in the journal account. No cash account is impacted. So very simple. Okay. Sold forward TT for 60,000. Okay. So buy sale of forward TT 60,000. Clear, guys? So two entries are clear to you. Okay, no doubts. Okay. Then comes the cancellation. If you now look at the right hand side, okay, what does it say? Forward purchase contract cancelled. $30,000. Clear? Remittance by TT. Clear? 75,000. Draft on Zurich cancel. 30,000. Okay, only 3 entries. So if there was a purchase, you must have debited it. Okay. If the purchase would have been there, you would have debited this. Now it's a cancellation, so knock off that entry. You will put the credit by forward purchase cancelled. Okay, debit like this, so credit like this, 30,000. Clear, everyone? Okay. Now the important thing, the first entry will be coming here, which is the concept of remittance by T. Okay. So we have made the remittance. So remittance will, when we make a payment, okay, don't go by learning anything. We have a credit balance of 1 lakh in our account. Okay, 1 lakh. Now we are making a payment. So when we make a payment, is our accounts increase or decreases? Sir, obviously it decreases. So it will come on the opposite side. Okay. So you will write to a remittance. How much? 75. Clear? And the double entry book system impact, it will come over here as well. If it's in the debit side, it will come on the credit side over here by a remittance through TT, that is 75,000. Okay, clear? Last thing, draft got cancelled. Okay, draft got cancelled. So where will it come? Any idea? Cancellation of the draft. To cancellation of draft. Okay, draft, when we prepare it, it is a sale. So cancellation will have a opposite impact, that is a negative, that is 30. Okay, so we have incorporated all the entries. Okay, and we are in a position to end this question. Now, what you need to do is, you can see in the last line, it says the you are required to maintain a balance of 30,000. Okay, in the Nostro accounts. Okay, so it should have a balance of 30,000. Okay, and for the Nostro account, it says you need to keep a balance of overbought position as 10,000. So how will you incorporate these entries over here? Okay. So the closing balance is required, which is to be done, is how much? 10,000. Credit side. Okay. BD and CD. Simple. So the total will be 60, 30 is 90, 1 lakh 75. What is the total out here? It is 80 and 80, 160. Okay, this is 160. So there's a difference between of 15,000. So 15,000 is the difference over here. For the timing, keep it like this. Okay, keep it like this. We'll come to that. Okay, and what is the amount of balance that we have to put in over here? 2 BD was here, so 2 balance CD would come here. Abhi, this account is yet to be closed, this account. So don't worry, 2 minutes. So balance CD has to be 30,000. Okay, required. Now, are they matching? No, sir. Why? Because this gives you 1,05,000 and this is giving you 1 lakh. So you will have to maintain this, you will have to buy a concept called as buy spot TT. Okay, buy from the spot market to maintain this balance. How much? 5,000. Now this can be 105,000. Okay, so to maintain the balance of 30,000, you will have to generate the right hand side, means the credit side higher. So you buy the spot TT over here. And how do you manage the this thing? You have done that. And if anything comes over here, beta, it comes here as well. Okay, you need 50,000 here. So what you will do is, the requirement is for 15,000. Okay, this 5,000 will come here. Okay, so 2 spot TT by 5,000. Okay, and in the overbought, you always do the transaction which is in the forward, not today, but in the this thing. Okay, so just to give you one thing you want to write in your notebooks, please write in the Nostro accounts, we do the things which happens on the spot market. Okay, and in overbought, we do spot market plus forward. Just write this, important from the examination. Okay, so here we bought the spot TT, so here we'll buy the forward. Buy forward to maintain the balance. Okay, so 10,000. This has given us the. So is it matching, guys? Is it clear? Any doubts? We have officially completed our more than half of the study material. Okay, more than half of the study. So there is one more question in your study material, very beautifully given. Okay, very beautifully given. So you can try that in your study material. It is given to you. Very simple question. It is given. So I'm not doing it in the class, and I will try to do it in the. You can try doing it. At the home. And if you get any doubts, you just let me know. Okay, clear? So no break as of now. Don't worry. Just a break for about 1 minute to see if there's any question from your side. Otherwise, we can start with the new concept of the forward contract. It's something which creates problem, which irritates a lot of students in their life. But I will try to simplify that concept as much as I can. Okay. So you have any doubts? Please let me know. Okay. No doubts? So can we clear this and can we move on to the next concept, beta? Forward contract. Okay. So as you already know what is a forward contract. Okay, the difference between forward and a future contract you must have studied in your earlier chapter. I will not be repeating, but I know that you know that forward contract is an OTC contract, over the counter. It's not a standardized one. Okay, it can be created according to your terms, according to your wishes. It's a customly made. Just for example, let's say I am wearing this shirt. Okay, it's not a custom made. Okay, it's a ready-made shirt. I went and said I have this size what I am wearing. Okay, 40 size is what I wear, the large size. Just give me some shirt of large size. They will give you. You check in the trial room and then you buy it. Sometimes you want a shirt which is, that's called as ready-made is called like a standardized contract, that you go and buy something which is already available in the market and you don't need to wait for that. You can just quickly go and do that. Sometimes there is a customized thing. Okay, so let's say somebody gifted me a raiment cloth for the this thing, what you call coat and a trouser. Okay, blazer, coat, whatever you want to make, and you want to get it stitched. That is called as a customized design. So you go for that. And generally, I think we know pretty well because as we have seen, mostly the female students who purchases suits. Okay, so they get the unstitched suit. So they buy the unstitched suit. They go to the boutique and they get their suit stitching done according to their own requirements. Men generally don't have that. They have their shirts, t-shirts available at a standard size, so it becomes easy. So similarly, forward contract is something which is customized to your own requirement and you can mold it accordingly. Okay. So again, nicely given in the study material, I will like to read few of the lines from there. It's the simplest form of derivative is the forward contract. It obliges one party to buy and other to sell what? A specified quantity of a nominated underlying financial instrument at a specific price on a specific date in the future. Okay. So let's take an example that you want to make a payment. You are here, okay, in India, and you want to study in the US. The fee says you have to pay them $73321.67. Can you buy this in the future market? No, because the denomination it is on the multiples of 10,000. Okay, and the expiry, the transaction in which it has to take place, it's always the last Wednesday of the month. Okay, just like any Thursday is your own expiry, like last Wednesday is your currency's expiry. Okay, so you make you can't buy that and it is not suiting your requirement. So you can go to the bank directly and say that, sir, sorry, not him. You can go to the bank and say, sir, I have to make a payment of this amount. So can you make the payment? Said, okay, we will make the payment. So we carry out a forward contract where one party is buying, means you are a buyer, okay, and other is a seller. Okay, so he is selling you specific quantity is this one. nominated underlying financial instrument at a specific price. So they will give you the quotes, okay? Or they would say $1 is equals to, let's say, 75.75, okay, as a rate on a specified date in the future. So let's say you need after 2 months, so you can do the standardized contract, okay? So this is called as the forward. In the exam and in your study material, how it is given, I will just explain you. So in your syllabus, okay, if you go by the study material, it is very beautifully given. I'll just tell you how they have done it. They said forward contract has 3 perspectives. Number 1, delivery. So what does that mean? I'll tell you. Means that the delivery of or the fulfillment of the contract, okay, is happening on a particular day. Okay, means the obligations are met. So delivery means, is it always we have to give something? No. You can buy also something. If you say that you want to buy those 73312 something dollars after 2 months, so you go to the bank after 2 months and you take the delivery of that. Delivery of what? Dollars. So that dollars can be paid to that university in the US. Come again. Delivery means that fulfilling the obligation. Okay, it does not always say that you have to give something. Okay. Fulfilling the obligation. Okay. So you are fulfilling the obligation. If you said, I will buy the dollars in 2 months, you went to the bank and took the delivery of that. If you said, I will sell 100 pounds in 1 month, okay, so you went there and gave the delivery of those pounds. So it means fulfilling the obligation. This can happen by 3 ways in the exam. It can come. So again, very nicely given in the ICS study. Okay, very nicely. The delivery is taking place on the due date. Okay, you promise that on the after 2 months you will be buying those dollars. You went there and everything happened very smoothly. Okay, so since it's not a very technical thing, so it will not be asked in the exam. That is for sure. Okay, I mean, this is very simple. The complication can be, which is called as the concept of early delivery. What? Early delivery. That you said, I have to make the payment for that fees in 2 months, and you get a call from that university that please pay the amount within 1.5 days. So you went to the bank and said, no, we don't. Although we said I need for after 2 months, but I need it now after 1 month. Now bank will be in a very embarrassing situation. I mean, not embarrassing. I mean, in a tough situation. So how do they manage that tough situation? This is in your course. You are getting my point. I mean, I'll explain you with a lot of example. Just understand conceptually. Just focus. Just imagine in your mind. Just visualize that you made a contract that after 2 months, okay, you will go and buy the dollars. Okay, and after 1 month you said, no, I need it right now. After 1 month. So that is called as the early delivery. Okay, let's take a funny female student example. Not funny for them, for their circumstance. So let's say a female student has given her suit to stitch to the boutique owner. Okay, she says, okay, beta, I will take 15 days to stitch that suit, because generally boutique owners have a lot of other people as well. So this student said, see, a female student said, no problem, auntie, I will take after 15 days, not a problem. And now in the meanwhile, after 1 week, she gets a news that one of her very close friend is getting married, and she wants to wear that suit in that place. Okay, so what she'll do? She'll go to the boutique and said, although auntie, I agreed with you that I need that suit in 15 days, but actually now there is a wedding, very important wedding to attend. I need this suit in rather than 15 days, I need the suit in 7 days. Can you deliver it to me? Okay. what she would say? Either yes or either a no. Said, no, I'm very full. You said, okay, take extra. Let your labor work extra hour. I will pay you extra. This is what the commitment is generally. Okay. So here also, the bank will not refuse you to take the early delivery, but they will charge you with some expenses. What are those expenses? We will discuss. You are getting my point? Have you visualized? Has ever happened with you that you've given a suit and you will get it after 15 days, but you need after 7 days? So they collect some extra payment from you. Okay. So I'm just giving you the name of those payments. We'll be discussing that going forward. Don't worry about that. So if you go for early delivery, you have to pay two things. One as the swap charges, swap difference, and interest on the outlay of funds. Sir, did not understand. I know, I have not even taught you anything. Did I teach you this? Did I teach you this? No. So don't worry. Just write it for the timing, beta. Just write it for the timing so that in the revision you are able to do that. Okay, clear? So the delivery means fulfilling the obligation. Firstly, on the due date. So nothing happened. You said I will be buying $1,000 at the rate of, let's say, 76 per USD INR. Okay, and you bought that, so nothing technical came out. In case of early delivery means you are coming before time, so you will have to pay these two amounts. Okay, I'll explain you this now. Okay, and third one is the late delivery. Means although you came to buy the dollar or sell the pound, just an example. Although you fulfilled your obligation, but you came little late. Okay, so bank was in a tight situation. Again, they would do something which is called as the concept of automatic cancel. They will take you all these funds just like this, plus they will do the automatic cancellation. Just in case any student who were from the old course and now they have come up with a new course, okay, this concept has changed from earlier. There is an amendment over here, okay, just like you have amendments in your law audit, there is a very small amendment over here. Or just in case somebody is giving a repeated attempt, okay, and they have an older book, so please see that there is an amendment over here. So whenever there is an amendment, there are high chances that this is testable in the exam. But Board of Studies has done our job very, very nicely. They have given this concept at the end. Okay, so they have explained you how to do this example of this, and this will be common in all the three that we'll be doing. So three, yeah. The first one is delivery, second is cancellation, third is the extension. So in all the three cases, this is common, and they have taught you this common concept in the last. Okay, I will also be able to do this in the next class, not today, because otherwise it will be too heavy in the same class. Okay, do not worry. Got it? So number one is I'm just giving you a very simple what you call as just overview as to what is there in your course as of now. So you have delivery, means fulfilling the obligation on the due date. Again, not a big technicality, something which was promised, it happened. You came for an early delivery, so what you need to do, I will be taking up one example and one question with you, so no need to worry. And if you are coming for a late delivery, then besides those this thing, you will have the provisions of automatic cancellation shall apply. This will be doing little later. Okay, so first concept is there. I'm just giving you overview. I will start my teaching with you on this concept just in a meanwhile. Okay, now the second one. First is delivery, second is called as the cancellation. Okay, you made up a mind that you will be going to USA for studying. But unfortunately, this virus came that flooded all your plans. Okay, so you call up the bank and say, sir, I will not be able to go to the US since it's a pandemic which is happening here. Lot many of deaths, lot many of people suffering from oxygen. So I just don't want to take a chance. I want to cancel that. So cancellation, you might have informed on the due date. Okay, the date you waited till, okay, let's wait if the pandemic gets over. On the due date, you call up them. No, sir, I will not be taking up the desired dollars that I wanted to buy. डॉलर खरीदने थे मुझे नहीं चाहिए आई डोंट नीड दैट एनीमोर पेंडेमिक इज गोइंग so you cancel that on the due date. Okay, second possibility is you know that the pandemic is going on, why to wait for the due date? You decide in advance that you will not be going to the US and you calls up the bank a month before, or let's say 2 months before, that you want to do a early cancellation well before time, because you know that in the pandemic you can't go. This is not a pandemic which will go in 2 or 4 days. It will take years. And the third one is it is on due date, early cancellation, late cancellation. Okay, late cancellation. Okay, so in that case, again, the provisions of automatic cancellation shall apply, and that we will be doing in the last. Clear, guys? So first is a delivery on the due date, again not very tough. Second is early delivery, which will be starting in just few minutes, and third one is late delivery. Similarly, you have a cancellation on the due date, early cancellation, and the late cancellation. So automatic cancellation provision shall apply. Okay, third one, beta, third one. Third one is called as, you say, okay, fine, I am not cancelling my program to study in the US. Okay, I am not cancelling it right now, but I am extending that for few more months ahead. I will not be going immediately, but I'll go after 3 months. Okay, so if that is the case, what do you ask? You ask for an extension of the contract. Okay, you said I'm not cancelling it. Okay, that's okay. The pandemic is going on. I'm extending that for few months. Let's say 3. Okay, or let's take a very practical example. Let's say you want to receive some goods from a country. Okay, you are an importer. You want to buy the goods from the other country. So the goods were not prepared. The vendor said there, you will get the goods after 3 months. Said, okay, fine, let me extend the contract with my bank. So you are informing him on the due date either. You are informing him about the extension earlier than the time, and you are informing him about the extension little late. So then also the automatic cancellation shall apply. So you can see all the 3 things: delivery, cancellation, and extension have all the 3 things common. It could happen on the due date, it could have early, or it could have a late impact. In all the 3 cases, it will be differentiated. Okay, clear? This is how the things has to be done in this manner. Okay, so can we start? Doing this. So the first thing that we need to understand is the concept of the on the due date. Okay, so something which happened. So the first thing means on the due date. We are studying first, that is the delivery, and that also on due date. On 1st March, Rahul, I have name I've already taken. Let's take Tina. Okay, Tina promised to buy 5,500 US dollars from Axis Bank Delhi branch. Okay, at the rate of 76.25. So this is what she promised. On due date, what happened was Tina came and she bought 5,500 into 76.25 and she paid the amount in INR. Okay, so no charges, nothing is to be paid. So that is on the due date, so nothing happened. Okay, clear? So this is simple. Now let's come to the second point, which is little technical, that we are making a delivery, but there is a early delivery in this case. What is there? Early delivery in this case. So what will happen? So in the same manner, I think study material also given in the same manner, so you can accordingly use that. A sequence I'm talking about. Sequence is also being same way it is being used in the study material. Okay. Now, if there is an early delivery, what is the complication that it can happen? Now see. Anjali, okay. This is bank HDFC. Okay. Anjali said that I will be buying say 1,000 US dollars. Okay. She will buy 1,000 US dollars at the rate of, let's take an example, 75.50. Okay. So she is buying, bank is selling. Okay. When? After 3 months. Got it? Anjali came to the bank and said, I want to buy dollars. Said, take. No, not right now. I want to buy dollars after 3 months. He said, okay, fine, not a problem. What is the decided rate? 75.50. Okay. Can the bank keep itself in a naked position? You have already studied in the derivatives chapter, two things are there. Covered call and a naked call. Okay? Or a naked position, whatever you want to say. Okay? Protective port and all those things you must have studied, right? So the concept of naked, can the bank keep itself as naked? Today they are promising that I will deliver you the, you can buy the dollars from me at 75.5. Let's take an example. After 3 months, the rate becomes 78 rupees. Just take an example, 3 months. So bank will be at a loss. Okay, how much? 2.5 into 1,000. Unnecessarily. Why would they incur a loss? So what they do is, to save themselves from that, they take a interbank position with some other bank. Okay, this is an interbank position with, let's take an example, SBI Delhi branch. Okay, they will sell $1,000 to Anjali at the rate of 75.5, and HDFC can buy the dollar from SBI at the rate of 75.25. So bank is in profit? Yes. Sir, why interbank the rate is low? Because bank, you know, together are brother and sister, so little lower rate. So clearly we can say that the bank is making a profit of 0.25 into 1,000. Clearly, $1,000. Clearly we can see this is the situation that she will be coming after 3 months. Okay, clear? Means that transition is happening like this, that let's take an example. She comes on 1st May. No, okay, December is going on. Let's take it 1st January. Okay, let's take it 1st January. Let's make the new year here only. 1st January 2022. Then I will be buying it on 31st March 2022. Okay, this is what a transaction is. So bank is very happy that if this transaction happens, I will be earning 0.25 per dollar. Clear? Simple. No complication till here. Any doubts? Let me just refresh it. Otherwise, I may move a little ahead. Okay, nothing. So this is the due date. Okay, this is the due date, and this is the contract date. Okay, so this happens. Now what happens on 28th of February? Okay, 2 months have gone. She comes and says, I want an early delivery of that. Just the suit example which I told you. You gave your suit to the boutique person. She said, I will deliver you in 15 days, but now you need the suit in 7, 8, or let's say 10 days. A bank cannot refuse you because bank always have the money. But why bank is having a problem is because they have already made a contract. If they can deliver you in 2 months, what will they do from the dollars that they receive in 3 months time? You're getting my point. On 28th February, they will say, okay, take that. From where will they buy? They buy from the stock market. Okay. So where will they buy? They can buy you and they can give. That's not a problem. But the main problem is that what will they do of those dollars that they will be receiving from the interbank? From SBI after 31st March, SBI will come. See, this is your $1,000. Will they accept that? No, I have already given to the customer on 28th. Said no, it doesn't matter to me. You told me that you need the dollars on 31st March. So you will have to take this delivery. Now the bank is having a problem. Now how will they manage with this situation? I hope the visualizations are clear, guys. Hi Akshay, interbank transactions also for yes, Pekan. Absolutely correct, production. This is also for 3 months. This is a 3 months. This is a 3 months. Same time will match, automatically match. It will be a problem for the bank that after 3 months, this branch will come and take, see, this is the delivery. Now, what will they do? Now you got the point? Yes, sir. Now the thing is, Anjali came on 28th February. Bank said, okay, ma'am, you do one thing. You sit in the manager's cabin. Have a cup of coffee. We will come back to you. She said, okay, fine. I'll wait for some. Then immediately the banker went to the spot market. Kahan gaya? Spot market. He said, what rates are going on? What are the rates which are going on? They said, sir, 75.35 and 75.60. Now you understand where are you? Okay, just try to understand. These are bid rates. These are ask rate. Okay, spot market. Okay, so I am a banker. I have to deliver it to Anjali. Okay, I have to sell her. I have to, as a bank, who am I? This bank. I have to sell the dollars to Anjali. So to have those dollars, I will buy the dollars. Okay, I have to deliver the dollars to Anjali. I will have to buy those dollars in the open market, in the spot market. If I am buying, somebody is selling. Okay, if I am buying, somebody is selling, and somebody sells at the ask rate. Come back again. I am the HDFC bank. Okay, I am the HDFC bank. I have to buy the dollars so that I can deliver to Anjali. If I am buying, somebody would be selling. And what is the rate that they will quote me? Bid rate or ask rate? They will quote me the ask rate. Okay, this rate, at this rate I will be buying. Clear? Yes, sir. This rate. One more problem. What, sir? On the due date, when SBI will come and say take $1,000. Now what will I do? अब मैं उसका क्या करूँगा? What will I do with those dollars? Then I said, listen, one thing, that see, this is a spot market. Do you buy also? He said, yeah, obviously. We sell also, we buy also. He said, okay, tell me, what is the 1 month forward rate? Okay. So they say the forward rate is, let's take an example, 75.10 and 75.90. Clear? Okay. So SBI, this SBI will give me $1,000 and I will be selling those dollars in the forward market. If I am selling, somebody is buying, and buying is always done at the bid rates. You're getting my point? This is happening, this transaction is happening on 28th of February. This transaction is happening on 31st of March. When I'm selling those dollars which I received from SBI. And this is, I am buying those dollars which I have to deliver it to Anjali. You're getting the point? I hope this is clear. So the whole transaction is clear to us, that this is how the things are panning. And there is Anjali. She's still in the manager's cabin, drinking coffee. She's okay, everything is fine. It's okay. In that meanwhile, the bank has carried out this transaction. They have made an arrangement to buy dollars for Anjali, and the dollars that they receive after 1 month from SBI, they have done the contract to sell them also. She's still enjoying her coffee. Okay, clear? Sure. Now what happens? The banker said, just one, okay? Now the banker comes. I hope it's not too many colors for you guys. Sorry. Okay. Now the bankers come. Okay, fine. You can buy this thing, dollars, as at this price. That's not a problem. Okay. Said, okay, fine. Anjali said, sir, this is the agreed rate, right? Yeah. So you just take this 75.50 into 1,000. So I will pay you 75. Decimal problem is there, right? 75 into 1,000. Yeah, 75,500. Money and icon. Listen, ma'am. Wait. Ma'am, we are at a loss. Sairam, I'm answering your question. I've seen your question. Ma'am, wait, where are you going? We are at a loss. Please sit down. You can't go like this. Please sit down. Anjali said, okay, I'm saying. Yes, sir. Tell me, what loss did you have? Ma'am, we sold the dollars to you at 75.50. But you know, we bought the dollars from this new bank at 75.60. So Anjali says, oh, you sir, you had a loss of 10 paisa? Yeah, I had a loss of 10 paisa. Getting my point, guys? Is it clear? Any doubts? Clear? Saira, are you understanding? So this was the loss to the bank due to early delivery. Now see very carefully, there thousands of students are making the mistake. Thousands of the students. Anjali says, sir, okay, not a problem, sir. Take this 10 paisa and let me free. Said, no, madam. No. This is the agreed rate. This will never change. Okay. I will not be charging this 10 paisa from you. Said, why, sir? He would say, you know, because of this transaction, I bought it at spot. You said, okay, fine. You bought it at spot, 10 paisa expensive. That's a loss. That's fine. I'm paying you. He said, no, it's now for about 5 minutes. So please tell me, if it is clear? Any doubts? So please tell me. We have a few more examples over here. So is it clear, guys? Okay. So if you prepare the chart in this manner, you will never have a, you can say, any loss of marks in the end. Come back to that. Sir, we understood this thing. You tell me one thing. Will always be a banker will be losing it? No. Sometimes the client, what do you call, achieve the profit. But they will get the profit only when they are coming on the due date or before the due date. If they are coming after due date, that will be covering the next class. If they are coming after due date, any profit made by the client, means Anjali, that will not pass on to the customer. That will be retained by them. But if there is any profit which is happening to any customer due to this market movements, that can be passed on to the customer, and that will reduce his or her cash out. Now we are going to the same concept, nothing much difference over there. The only difference will be that now it will be a situation that the bank is not making any loss. It means, on the contrary, the bank is making a profit. And how is it passed on to the customer? In form of both swap difference and the interest on outlay, we'll be discussing. Just in case it got little bit hodgepodge, I will try to make it more cleaner in the next example. Okay, so can I rub this? And there is one student with a very nice name. What his name is? Mr. Sukhwinder Singh. No, Sukhjinder Singh. Okay, sorry. So Sukhjinder ji, there is nothing to worry. I am to send the queries. I don't think that you can use any link on the YouTube. So you have to use that link from where you have downloaded the assignment. Okay, so you can post your queries as much as you want. Okay, and I'm able to at least see this one. So I don't think YouTube gives you an option. So please put it here. You have any doubts? Okay, so I hope this is clear. So let's move ahead now. Okay. So no other queries, I hope. Okay. Now the changed scenario is in front of you. Okay. Just 1 second. Let me make some adjustments to this. Now, beta, another example. I'll just show you. Okay. See, if you're making this kind of a diagram now, you will never ever have a problem in your life. Okay. Let's make it quickly. This is a bank. Okay. So let's name it some other. Union Bank of India. Okay. Union Bank of India. This has made a contract with a customer that this will be selling now, let's say, a little higher dollars. $1 lakh. Okay. And the rate will be, let's say, 75.5. Okay. And as a result, they made a similar arrangement with this interbank. Okay. Say Bank of Maharashtra, Bank of India, at the rate of 75.25. Okay. Sir, are we supposed to do anything with this rate? No. Sir, even if this rate is not given, can we proceed with the exam? Yes. Okay. Now, if there is a question of the early delivery, we have to see that how Union Bank is managing to fulfill the client's requirement which came before time. Okay, the scenario remains same. Everything remains same. That this customer was supposed to receive this money in, say, 3 months of time. Okay, so 1, 2, and 3. So they came after second month. Okay, sorry, 0, 1, 2, and 3. So they came after 2 months when the spot rate. Now you know na, that why spot rates are important, why forward rates are important. So everything is given. Spot rate is 75.25 and 75.30. Okay, and 1 month forward 75.45 and 75.5. Okay, beta, clear? Any doubts? The transactions took place, okay? Amount to be paid by customer. She made a contract for $1 lakh and she would pay into 75.50. So they would pay how much? 7550. Okay, 75 lakh 70,000. Now the calculation of the swap loss or gain, now that is important. Okay, so before we calculate that, let's see that because of this early delivery, at what price did the bank buy? Somebody came in 2 months and said, okay, deliver me. The price was going on. Union Bank will be buying to deliver it to the client. So they will be buying and this some other bank will be selling. So this ask rate is applicable. This is just we studied few minutes back before the break. So no change in that. So the Union Bank is buying at 75.30 and delivering it to 75.5. So is it a gain to the bank or is it a loss? It's a gain. So this gain will be passed on to the customer. Why? Because they came either on due date or before the due date. You are getting the point? This gain beta will be delivered to the client because they came before due date or after with that. Okay? Just in case they are coming after the due date, the automatic cancellation will apply. That will be doing it later. So now since they came before time, this gain will be passed on to the customer. And how this gain will be passed on? This outflow will get reduced. Okay? So this is how we've done. The last example that we did, the bank suffered a loss and that loss was recovered from the client. And now there is a profit. This will be passed on to the client because he is either on time or before time. Clear, beta? Sure. Now let us understand, beta, how this thing will be there. Let's take two rates: interest on outlay of funds. Okay, let's say it is 10%, or interest on inflow of the funds. Opposite of that is, let's say, 8%. Just an example. Okay, so here the bank is buying from a third bank. Who is the third bank? Union Bank is the one. They have done an interbank transaction with Bank of India. Now the customer came in 2 months, 3 months se pehle. Okay, so now they are buying from this at 75.3. So this is called as the swap gain. Okay, swap gain. And the dollars they will receive from Bank of India after 1 month, they will also be selling that, and the bank will be buying that at 75.45. So in both the situation, the customer gains. Okay, how did they gain, beta? See very carefully. The swap gain is calculated. How to show it in the exam? Otherwise, it's very beautifully given in the study material. Okay, so you will do 75.30, okay, minus 75.50. I know it's a negative figure, but you have to show it like this in exam. Okay, into 1 lakh. So I think 20,000. 20,000. So customers is very happy. Okay, fine. That's great. This will be payable to the customer. Now, one more thing. Now the bank, the difference between cash inflow and cash outflow. Now the bank is paying less from his pocket and receiving more from the customer. In the previous example, they were paying higher. So they charge their opportunity cost from the client. Now they are paying less from the pocket and getting more from the client. So the difference in the amount, the customer will get the money. The customer will get the opportunity cost. Okay, the deposit cost. I'll tell you how to present in the exam. The interest on inflow of funds. Okay, the higher funds paid by the customer, higher funds. Okay, so how much beta did they receive? Cash inflow. How much did they receive? They received 75k basis pay. Okay, so 1 lakh. Any doubts, guys? I hope that is clear. Into 75.50, so 75 lakh 50,000. Okay, and what is their outflow? There means Union Bank's outflow. So cash outflow is equals to 1 lakh into 75.30. So 75.30. So they received 20,000 extra. So sir, will this pass on to the customer whole? No. Only opportunity cost. Only. In this case, this is a benefit. So how do they make the calculation? For outlay of the funds, if bank is shedding more money from their pocket, they will charge 10% from it. But if you are giving more amount to them, they will pay you 8%. Okay? So let's calculate better. Interest on inflow of funds. So 20,000 into, I would say rather how much? 8% into 1/12. Okay, so let's calculate. 20,000 into 8% divided by 12. So 1333. Okay, so 133.3. Okay, so this and this are the benefit for the customer. Okay, these are the benefits for the customer. This will be paid to him. Okay, this will be paid to him. Payment means that will reduce their cash outflow. Okay, that will reduce their cash outflow. How come? I'll show you. So you'll write the final answer. Total cash outflow will be 75.50 is what is required to be paid by the client. That will be reduced by 20,000 because the bank made a profit, and this profit will be passed on to the customer. Why? Again, I'm saying because he or she came either on the due date or before that. Okay, minus 133. Let's take it point, not 0.3. So this. So 75. Okay, 1750 minus 20,000 minus 133. So the net amount of payment by the customer was rupees 7529,867. Done. Okay, beta, any doubts? So in this case, it was a profit for the bank, so they passed on to the customer. Okay, I'll wait for about a minute. If there is no doubt, then I have to quickly move on to the next question for us. Okay, should I wait for a minute, beta? Any doubts? Okay, so I'm presuming that the things are absolutely fine at your end. Okay, because I have already refreshed it and I am not able to see any doubts in your case. Okay, fine, beta. Chalo. So now let's move on to the next question. This is from your November 2008 paper. Okay, November 2008. So you must have your assignment, beta, and it is always requested. See, ICA makes so much efforts that they deliver you assignment before time. So at least do that understanding. So what about the interbank transaction? I just told you, beta. I just told you. See, interbank transaction has already happened. It has nothing to do from charging from the customer. Okay, it has nothing to do with the charging of the customer. I just rubbed that. The loss which happens just in case between interbank and the forward, that is already being charged from the customer. So you don't need to do that. Always in the exam, you have to see that what is the amount payable by the customer. If there is any profit, the outflow will get reduced. If there is any loss, the outflow will be increased by that loss. I told you in the very starting, just in case the examiner is not giving you at what price the interbank transaction is happening. Does it really matter to us? The answer is No. What we are concerned is that if he is before time, what is the loss the bank has suffered so that can be charged. That is only required. So in the going forward questions, na Sairam, I will not even be taking the interbank things. Okay, I mean there's nothing to do with that. So I will even ignoring that. That was just for your understanding. Okay, beta. Can we do this question again? Very brilliantly framed by the examiner, and that is available on the website. You can just refer it. This is your November 2018 paper question. Very nicely framed. Okay, so let's understand this. On 19th January, a bank entered into a forward contract with a customer. Just one sec. Sorry, just one sec. Yeah. Bank entered into a forward contract with a customer for a forward sale of US dollars 7,000. Delivery 20th March. So, if sometimes in the exam, see, examiners are not always wants to, trap you. They are sometimes good. Why? Because if I'm not able to understand that what is the transaction taking place, just apply the logic. Okay, just apply the logic. Bank A is selling or buying the dollars. We don't know. So we know by common sense, they buy at a lower price and they sell at a higher price. So the original transaction which the bank is doing with the customer is that they are selling $7,000 at the rate of 46.67, and to cover that position the interbank is happening at 46.655. so if we are not sure in the exam whether it is a selling transaction or a buying transaction, that can be cleared with the help of the interbank transaction. But again, Sarah, not required. Okay, what we require is over here. So now this is clear, quite simple, because now this question will become very simple for you because you have done 2 examples from it. Okay, that were on conceptual examples. Now we are headed toward the examination question. Okay, you want to practice this more, you can study, refer the study book. Okay, $7,000. Now comes the story. The transaction which was happened to be for 19th January till 19th March means 2-month transaction. Now this gentleman is coming on 19th February. After 1 month itself, the customer approaches the bank and requests for the early delivery. Please check these things in your exam. Okay. People always say, sir, extension is important, cancellation is important. See, anything is important. The examiner can ask you individually a direct the early delivery and also ask you for a cancellation or the extension. So don't try to time the market that time the exam what they will be giving. Anything can come, just be get it. So just underline this in your assignments that they are going for an early delivery of US dollars. Rates prevailing in the interbank on that rate were this and this. Interest on outflow of the funds is 16%, inflow is 12%. Now what is this? I've already told you in the last example. So I'm sure now you are able to understand. Flat charges are 100 rupees. Sir, what is this? This was not there in the earlier questions. Yeah, I know. It was not there in the earlier question. It's just that you need to add it simply. So flat charges is something which is there. So nothing much technical. What is the amount would be recovered from the customer? Recovered means you have to carry out sell. You as a bank would be selling. So you will be receiving the money. And any gain will be passed on to the customer and any loss will be charged from the customer. This you have to show it to the examiner as either the swap loss or a swap gain or interest on outlay of the funds or interest on the inflow of the funds. These 2 calculations are very much required from the examination perspective. Okay. So calculation should be made in months, on month basis, then on day basis. So it says don't go by the day thing. It's 1 month, 2 months. I mean, it's totality a 2 months transaction. Okay, and he is approaching 1 month early. So examiner has made the life more easier for us. No? So what's that? So I think it's quite simple and a straightforward question, students. They're asking you to calculate two things. One is the swap difference, and one is the interest on outflow or inflow of the funds. So can you calculate? And now, so you have already studied from me, and you had the assignment from the BOS. Okay. So can you try this? Should I give you only a minute? Otherwise, they'll start doing it. Okay. Can you share the answer for the swap difference? Okay. Okay. I'll also start. Okay, so what is happening is, let us understand. The bank had an original transaction to sell at 7,000. Eraser. Okay, the bank had an original transaction to sell $7,000 at the rate of 46.67. Clear? Yes. Now they are coming little early. Okay. Now, as a result, to deliver it to the customer, me as a bank would have to buy $7,000. You are getting my point? I'll explain you over here. Now, don't go by the interbank. This is not required, Sairam, as Sairam had asked about 10 minutes back. So now this is not required. I'm saying that this is the original transaction to sell $7,000 at the rate of 46.67 to this customer. Now he comes 2 months little earlier. Okay, he comes little 2 months earlier. So as a result, bank had to approach another interbank, and to deliver to the customer to sell that, first he need to have the quantity himself. He went to buy the dollars. If he is buying, somebody else is selling. If he is buying, somebody else is selling. Okay, and at what price would they sell? This is bid rate and this is ask rate. Okay, so the bank would sell at this. Clear? No doubts? Okay, so because of this, the bank will have to buy this at 46.5800. Clear, guys? So you tell me, the bank had a loss or was it a profit? You have to see very carefully. Was it a loss or was it a profit for the bank? So the bank buys at 40. Okay, buying at 58 and selling at 67. Okay. Just 1 second. Is it? Yeah, rates are fine. Just 1 second. No, bank is having a profit. Yes, yes. Sairam, just 1 second. Has we made any? Okay, no. Covered the same from buying at this price. Okay. Bank made a profit. Okay. Bank has made a profit. Okay. So they are buying at a cheaper price and selling at this 35. kahan se aaya? Spot and the March. Fine. Okay. So to cover up that, so they are buying at a lower price. Okay, and selling at a higher price. So the bank made a profit. Clear? No doubts? That's done. But this is not something that they'll be charging. Okay? This is not the concern. Okay? You remember that? The example of Anjali, as I told you, Anjali said, sir, you made a gain of 10 paisa. You remember the transaction which was happening at 75.60 is what Anjali had done the transaction to buy the dollars, and the current market price was going as 75.50. So she said, sir, you made a profit of 10 paisa, so you need to pay it to me. But this is not, we have to see it in the exam. What you have to see it in the exam, Sairam, I was just trying to see what the thing you have to see in the exam. That even if it's a profit, we have to see the difference at what price the amount of dollars that they receive from the interbank. At what price will they sell it? And they will sell it at the 1 month forward. Sir, it is getting little confused. Okay. We have a lot of time. Just understand now carefully. This scenario is whole clear. Let me take you to the next slide. Just 1 second. Okay. We'll have more space here. Okay. Yes, sir. It was getting little complicated. This is the bank. Okay. This is the customer. 2 months contract. Okay. 1 month early delivery. Yes, sir. This is so clear, sir. Sir, we are confused about the rates. I know you are confused about the rates. Don't worry. Done? Done. They will be buying $7,000. Yes. Okay. At what price did they say between them? 46.67. And interbank 46.655. Clear? Yes. Because of that early delivery, the bank had to approach another interbank. Right? Yes. They will be buying dollars for the delivery to this customer at the rate of what price? The ask rate. Okay. The ask rate was 46.5800. And the dollars that they receive after 1 month from here, they will be selling that. Okay. This dollars that they receive, who will receive? This person. Once, abhi to de diya. I mean, they have already given it to the customer. They bought it right now and they sold it. This is already done. Now what they do is they will be, this is a spot rate and we will sell in 1 month's time. Okay. And what is the 1 month forward rate? The forward rate is this rate. Which rate? This rate, beta. Okay. So the swap difference will be the difference between this rate and that another rate. I'll come back to that. So 46.3550. So they sell it at 46.3550. Clear, guys? Any doubts? So I was just trying to honestly trap you guys to see that what is the transaction which is happening. Although the bank is making a profit, okay? Although the bank is making a profit, but this is not how the things work out. You just can't blindly see as to what thing is happening, okay? You have to see that, just 1 second, where is that? Sorry. Oops. Just 1 second, huh? Just the question has gone somewhere. Just 1 second, huh? Just 1 second. The question has gone somewhere. Oops. Just 1 second. I think by mistake I closed that. Maybe just 1 second. I'll just reopen. We have a lot of time. Nothing to worry. Yeah. So I hope now it is visible. Sorry for that. By mistake I must have closed that question. Okay. So where is that answer? Oh, just got Okay, this is the bank. Customer, 2 months transaction, 1 month early delivery. Okay. So here, as we can see that the transaction which is happening with the interbank was 46.655 and this is 46 point. It was, I think, the another one 46.67, right? 46.67. Now the transaction which is happening with the other one, another one is at 46.58. 46.58. This is what they are buying from the interbank, and the money at the dollars that they receive from here, they are making a 1 month forward. Okay, 1 month forward, and at what rate? 46.355. Okay, 46.355. Clear, guys? So now we will calculate the swap difference. Okay, swap difference. So what is the difference in them? Okay, the bank had to buy at what price? Bank, this bank, okay, buys at 46.58. Clear? And they make a forward sale at 46.3550. Okay. Okay. So this created a loss for the bank. Bank buys at this and they will be selling this. Ye dollar kaun sa hai? This is what is that dollars that they will be receiving from that interbank. Now, because of this customer coming little 1 month earlier, okay, now in 1 month he got free. Okay, we bought from the spot, we gave him that. That's not a problem. And they made a gain also. But we have to see that the dollars that they will be receiving after month, at what price are they selling? That is the most important. The difference between the two rates. That is why I was saying that this diagram is the most important one to understand and prepare it in the examination. Guys, any doubts still here? So what is the net amount? 46.58 minus 46.3550. Okay, so you had a 225 into 7,000. 1575. Okay, guys, no doubts till here. This is the swap loss on the $7,000. The charges to be charged from the customer because of that early delivery. Okay. Now, it is not always the thing that you have the outflow of the fund. Now you have to see at what price did the bank buys and what is it sells. Okay. Now it buys from the customer at, the interest on inflow. Sir, why inflow, not outflow? I tell you, just wait. Cash inflow. This is in perspective of the bank. Okay, you are a banker. Uski perspective mein you have to think. Okay, the cash inflow they receive from the customer 46.67 into 7,000, and what they put from their own pocket, they put cash outflow as 46.58 into 7,000. So in this case, they paid out less money. Okay, so they put in less money, higher money was given by the customer. So the bank will have to compensate for this additional money that they have paid. Okay, so you are getting my point. So the difference between these two rates, beta, you have a yellow color, yeah. The difference between these two rates are the swap difference, and difference between these two rates are interest on outflow or inflow. This, a lot of students are making the mistake in the exam. They just ratify the concept. That is why I have made this chart so that you are in a situation to do that. Okay. So how much did you pay? Can we wind up this? 46.67 minus 46.58. Okay. So into 7,000. So 630, but that is in totality. Okay. Wait. So net, that is 630. You have to do the calculation for that. You will have to pay them. I think 12% was the amount. 12% into 1 by 12. 6.3. Okay. So this is what the customer will pay. This is what the customer will receive. Okay. Because they paid less amount. And there's a flat charge as well. So the net payment by the customer. Okay. So can we calculate the net payment by the customer? Okay. So he paid the agreed rate 7,000 into 46.67 plus a flat charges of 100 plus 1575 as this amount, and he received 6.3 as the total amount. Okay. So he paid up 7,000 into 46.67 plus 100 plus 1575 minus 6.3. So I am getting the answer as 328,358.7. Okay. $328,358.7. So guys, tell me, is it clear? Is it understandable? Any doubts? We have 1-2 minutes. I mean, that can be extended. That's not a hard and fast rule. That's not this thing. So beta, this is how the understanding needs to be done in case of early delivery. So as I told you, we have completed one part which is called as the delivery. On due date, it was a simple one. Early delivery will have two things: swap difference and the interest on outflow of the funds. Okay. And the other one, cancellations, extension, that we will be covering up in the next class, which will be taking place on the coming Friday. Today is Thursday, I guess. So Friday we'll be covering up that, and followed by winding up this chapter on Monday. So any doubts, guys? I think sir is not there with us today, maybe because of some very important some commitments. So with that, sir, charges will be deducted from the customer. Yeah, I have deducted. His outflow is got added, na beta. Sir, charges will be deducted from the customer's inflow. So customer is making an outflow of 46.67 to 7,000 plus flat charges are 100 plus 1575 is what he's supposed to pay, reduced by 6.3 as the interest that he received. Clear, Sairam? Okay, beta. So any further doubts, guys? Should I refresh the questions? Okay, so no further questions. I guess now you are in a situation to understand this more prominently. Okay, so with that, I think we can end today's class. Okay, so I hope you enjoyed the session. I enjoyed a lot. We have covered up a lot of concepts in today's class, and we will keep that spirit up in the next class as well. Okay, guys. So see you in the next session, same time, same place. I mean Zoom and YouTube. And thank you all students for participating so much in today's class. Okay. Thank you and take care. See you in the next. Bye-bye.